Have you ever wondered how basic interest is calculated on a loan or savings account? Let's break down the mechanics of simple interest. Simple interest is the most basic way to calculate the cost of borrowing or the earnings on your savings. The math is straightforward. You multiply the principal amount by the annual interest rate and the number of years. Unlike compound interest, where you earn interest on your interest, simple interest stays flat because it only looks at the initial principal. The main difference is that simple interest remains steady, while compound interest accelerates your balance as time goes on. In this chart, you can see that the interest added each year is identical, creating a flat, predictable trend line. Always read your loan agreement carefully to understand exactly how your interest is being calculated before you sign. Thanks for watching. Understanding these basics helps you make better decisions with your money. Subscribe for more finance basics.